So, you're an entrepreneur, you're trying to raise money. What's the deal with all these venture capitalists? They're taking meetings, but they're not actually writing checks. When's this venture market going to reopen? That's the topic I want to talk about today because, it's a question I get a lot on both sides. I mean, I guess from VCs, I'm not really getting the question of when will the market reopen. It's more like, hey, yeah, we're basically sitting on our hands. The flip side is entrepreneurs are kind of frustrated because, some of them are just like, hey, I just want to start a new business, or hey, this is, the timing just kind of hit us a little flat-footed. Like we were planning on raising now anyways, and yet nobody's writing checks. Or in some cases, like they've run out of money and they need to raise more money in order to build a successful business. And so a lot are kind of asking themselves, like, when do venture markets reopen? And I think a lot of VCs, if they're being honest, are also asking themselves, like, when do the venture markets reopen? Like, when do I step back in and start playing and making investments? And it largely centers around the question of when is the next recession? Are we going to have a recession? When's it going to hit? When are we going to come out of that recession? And, in some of my other videos, I've admitted that like VCs are kind of like lemmings. Like, we wait and watch and see what other people do and what they get excited about. And so, I think there's a little bit of that too, of like waiting and watching to see what other VCs do. And then, you have things like the collapse of FTX, which doesn't help anybody. And I hate to say it, but like, I wish I could say that like I'm surprised, but I actually think there are going to be more collapses of top tier companies that ultimately like don't have enough money on their balance sheet in order to survive this next downturn. And they'll go back out to investors and their unit economics won't look good enough in order to raise more money. And what I mean by that is that some of these businesses have been raising insane amounts of money to grow at all costs. And when we say like grow at all costs, like that seems like, it's just like a phrase, but what does it actually mean? Well, it means that you might go out and spend a lot of money to acquire customers, even if it means you lose money on every single product that you sell. Well, that doesn't work ultimately, right? And you could make the argument, sometimes there are good arguments to be made there, right? Bill Gurley's famous for saying that, there are businesses that are out there that are they're growing because they're giving away dollars for 50 cents. And, that's fair. But sometimes you got to give away $1 for 50 cents if you're trying to change customer behavior, which is exactly what Uber did and Lyft did, which Bill Gurley was an investor in Uber, right? That's exactly what they did to change customer behavior. But over time, that customer behavior changes and people, they can't live without Uber and Lyft and they're willing to pay up more, right? So it can make sense, but it's kind of got to be a special situation. And I think what's happened in the last couple of years is a lot of companies have been giving away dollars for 50 cents, not because they needed to change customer behavior, but because there was so much pressure to grow at all costs. And then what they would do is they'd have all these vanity metrics, like look at our year over year growth rate. It's so great, blah, blah, blah. And like our customers, this and that and whatever. And that's why we should be valued at these astronomical valuations. And venture capitalists were like so afraid of missing out on the next big thing that they were just pumping tons of money into these companies. I mean, like I've talked a lot on my channel about FTX as an example. They've raised hundreds of millions of dollars without a board, without good oversight. Like those are the kinds of things that were happening over the last couple of years, where investors were like so eager to get deals done that they would do them at almost any terms and any amounts of cash. And, and that was perpetuated in large part because as a venture investor, you were watching that same thing happen with your portfolio companies. So let's say you invested in a company like 7 years ago, and it was finally coming into its prime. Other investors were flooding in and pushing up the valuation. And so on the one hand, you were benefiting because your portfolio was just absolutely crushing it and doing really good and high valuations and going public and getting acquired and so on and so forth. And so then you felt like you had all this additional capital and the ability to invest in really high-priced companies and valuations. And so that just kind of perpetuated it, right? It was like this like circle of like, hey, my portfolio is doing great, so I can invest at high valuations, and then that would make another venture fund's like portfolio look good, and they would invest in high valuations that would impact your company, and so on and so on. Ultimately, I think 2021 was a great year to sell businesses and get out. And that's really like what you should have focused on as a VC, not doing deals, but just exiting businesses. Of course, that's easy to say as somebody, looking back with 2020 vision, right? But nonetheless, how do we get out of where we're currently at? And, kind of coming full circle, a lot of VCs are afraid today that if they make an investment in a company at today's valuations, that there is a chance that we head into a recession. And if we head into a recession, valuations could drop even more. And VCs do not like down rounds. If you think about how VCs get rated, monitored, benchmarked, whatever, like what do they report? They report on the performance of their investments. And most venture funds will just mark to the last round valuation, even if that's not the true valuation of the company, because it's not like the public markets where these things trade every day up and down. And so you have a good idea of what a company is worth at any given moment. In venture capital, company might raise capital once a year, every other year. And so you have these big, long periods where valuations look flat, even though they could be going up or down. You just don't know because they're going to be impacted by how the company is performing. And then they're also going to be impacted by the macro environment. And so you have a bunch of these VCs that are sitting there saying, well, I don't want to invest in a company right now. And then 6 months from now, the company's got to raise more money and they have to do it at a lower valuation because that's going to look bad on me. And if my companies end up performing worse over time from even if the company meets all of the metrics, even if the company outperforms what they told me they would do when I invested, the macro environment is so uncertain right now that the company could still end up taking a down round. This is happening to us right now in our portfolio. We have a company, a phenomenal company, outperforming a lot of their metrics and plan, doing really well, and yet all of their peers have taken a massive hit in the public markets. And so this company ultimately is going to take a down round. And it's super unfortunate and really frustrating as an investor to be like, this is a company that's absolutely killing it, and yet it's on paper it looks like we made a bad investment, when in reality I think ultimately the company is going to be fine and continue to perform well and we'll end up generating a good return. But nonetheless, these things there's so much uncertainty and it's so scary, and I think a lot of venture funds are kind of going through that right now. The flip side of that is a lot of these venture funds have closed big funds in the last year or two. And so they've got a lot of dry powder to deploy. So they're sitting on their hands, but they can't sit on their hands for too long. And what I anticipate happening is we might run into a recession in Q1, Q2 of next year. We'll see. But I think VCs will start reopening their pocketbooks probably about that same time, kind of end of Q1, beginning of Q2. There's always usually a little bit of pickup in venture activity at the beginning of the year in January, February. So I wouldn't be surprised to see some of that happening, just as more of these funds say, hey, we've got all this capital we need to deploy. We think that we've probably hit the floor here. And what's interesting about economics, particularly kind of macroeconomics, is that the performance of the overall economy is really driven by consumer and investor confidence. And if investors and consumers are confident that things are going to get better, then they get better. And that's because investors start feeling confident about making investments. And as they invest in companies, those companies have more resources to hire more people and to spend more on products and marketing and so forth. And that just creates more business for more businesses, and creates more employment opportunities. And as more people are employed and they make more money, they can spend more on necessities and luxuries and so forth, and add more fuel to the economy, and then the economy starts to pull out. That's how these things happen ultimately. And so look, I think we need to hit some sort of floor that the majority of people can agree on, that, hey, this is kind of the floor, this is the low, and now is the time to start buying when things are cheap. And when that happens, I think you'll start to see a turn in the economy. Generally, you can watch the stock market. I think you can also watch the Fed and see what the Fed is doing. As the Fed starts to stop raising rates and raising the cost of capital, I think that will be a very positive sign that they feel like they've conquered inflation, or at least fought it back and gotten it under control. And once that happens, then they can start thinking about maybe reducing rates. And all of that will be like a good indicator that we've hit the bottom and coming back out of it. The stock market will probably be a leading indicator of that, in that you'll probably, you would hope to see the stock market start to rebound a little bit ahead of the general economy. And that's because investors hopefully are seeing that, hey, we've hit the bottom and now's a good time to invest and start putting more money in. And all of those things will help build additional confidence and help pull us out of this. But it's going to be rough. And like I said at the beginning of this episode, I think there's going to be a lot more pain to be had here. I don't think we've hit the bottom yet. And so if you're a company, you should be extending runway, cutting your burn, making sure you can survive. If you are an individual, make sure you've got plenty of money in savings, because you don't know if you're going to get hit by one of those layoffs. And, if you're an investor, keep an eye out for great opportunities, because there will be situations where there are fantastic companies that are raising at substantial down rounds and really attractive prices. And don't let fear get in the way of being a little bit greedy. As Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy. Last year was the year to be fearful. This year and next year, I think, are the years to be greedy. Anyways, thanks for joining. Check out some of my other videos, like why are there so many layoffs? I think you'll enjoy it. Thanks. Bye.